The warnings of a global trade war grew deafening, as Washington stunned the world with an extraordinary order. 27 nations were told to impose a sweeping 100% tariff on every single Chinese product, a measure without precedent in modern economic history. It was a demand so vast that it shook markets before it was even put into action. Yet almost instantly the plan began to fracture. Germany cautioned that nearly 500,000 jobs could be lost overnight. France warned that its billion-euro luxury sector, the crown jewel of its economy, might collapse. Eastern European governments feared factories could grind to a halt within days, unable to access the Chinese parts and inputs that kept their assembly lines alive. And as hesitations spread across the continent, Beijing struck back with a blunt warning of its own. It could cut off rare earth supplies, the critical minerals that keep U.S. missiles airborne and electric vehicles moving. What had been framed as America's decisive offensive against Beijing was crumbling in real time, collapsing under its own weight, and the world was left wondering what would follow. Washington had justified its push by pointing to China's growing ties with Russia. The public argument linked Beijing to Moscow's survival, insisting that Chinese purchases of Russian oil and gas, worth an estimated $62 billion in 2024, according to customs data cited by Reuters, were effectively underwriting the Kremlin's war machine. By hammering China with tariffs, the United States claimed it could indirectly weaken Russian energy revenues. But the logic quickly unraveled. Oil and gas shipments are bound by contracts signed months in advance, meaning tariffs imposed today would not cancel deliveries already locked in. European governments knew this, and they questioned whether Washington's justification was more political theater than economic strategy. The sheer scale of the demand only magnified their doubts. Europe was already wrestling with its own internal storm. On October 1, 2025, Reuters confirmed that Brussels was preparing strict steel import quotas with tariffs of up to 50% on volumes above those limits. That policy alone risked causing supply shortages for construction companies across the continent. Adding a blanket 100% tariff on Chinese goods, as U.S. negotiators were demanding, risked outright economic chaos. Europe's carmakers, electronics manufacturers, and pharmaceutical firms all depended heavily on Chinese components. To cut them off in one stroke would not simply hurt Beijing, it would paralyze Europe itself. Germany, the backbone of the European economy, was especially alarmed. Bloomberg reported on September 28 that German exports to China hit $97 billion in 2024, making China its second-largest trading partner after the United States. German automakers were already struggling in China, losing ground to local electric vehicle competitors. A sweeping tariff regime risked accelerating that decline and handing their hard-fought market share to Korean and Japanese rivals. France, meanwhile, saw its own flagship sector in peril. Customs data cited by the Financial Times showed French beauty and cosmetics exports to China had surged 14% in 2024 alone. A tariff wall would not just slow that growth, it would erase it overnight. For all its boldness, Washington was not negotiating from a position of strength. On September 30, 2025, U.S. Trade Representative Jamieson Greer told reporters that the current 55% average tariff rate on Chinese imports was a good status quo. Yet he warned that if talks failed, the United States was prepared to raise the rate to an astonishing 145%. Reuters carried the quote word for word, and markets shuddered. Semiconductor stocks in New York fell more than 4% in a single session, while American agricultural exporters began bracing for Beijing's retaliation. And retaliation was not hypothetical, it was recent memory. On April 4, 2025, Beijing had already slapped an additional 34% tariff on U.S. goods and tightened export restrictions on rare earth minerals. The impact on America's defense supply chains was immediate and severe. Those measures landed at a time when the U.S. economy was already flashing warning signs. The IMF's April 2025 outlook had cut the American growth forecast to 1.9% from 2.4% and raised the odds of a 2026 recession to 40%. While Washington framed tariffs as reciprocal measures, many economists saw them as political tools meant to substitute for blocked fiscal policies. In May 2025, Wall Street Journal columnist Greg Ip argued that tariff escalation had become a stand-in for stimulus in an era of congressional gridlock. Investors saw merit in that claim. Bureau of Labor Statistics data showed that household prices for goods hit by tariffs had already jumped 12% in the second quarter of 2025. Beijing's response was calculated. When the United States raised duties to 145% in early May, China did not lash out immediately. Instead, it bided its time, waiting until trade negotiations in Geneva on May 12. That day, Reuters confirmed that both sides agreed to a major rollback. Washington reduced its tariff spike from 145% down to 30%, while China cut its retaliatory duties from 125% to 10%. For 90 days, a fragile calm returned. Container data from Lloyd's List showed volumes between Shanghai and Los Angeles rebounding 9% in June compared to April. The lesson seemed obvious. Escalation could be reversed when political costs grew too heavy. But the truce was built on sand. By July 22nd, as Trump touched down in Manila to negotiate a Philippine military access deal, Reuters revealed that without a new accord, tariffs would automatically snap back to their peak levels, 145% on Chinese imports into the U.S. and 125% on American imports into China. The so-called snapback clause rattled investors worldwide. It meant that every temporary ceasefire carried the constant threat of sudden collapse, turning global supply chains into hostages of politics. European governments, watching the volatility, questioned whether it made sense to tie their economies to such unpredictable trade policy. And the challenge grew even sharper with India's position. On August 6th, the White House accused New Delhi of quietly undermining sanctions by buying record amounts of Russian crude, further straining the already fragile coalition Washington had sought to build. Instead of showing unity, the Western-led front was fraying at its edges. What began as America's bold attempt to isolate China was spiraling into a global standoff, where every player weighed its own survival above Washington's demands. By 2025, the global trade system was already under strain, but a series of events turned what was once considered economic competition into something closer to open confrontation. Reuters reported that Russian oil accounted for 37% of India's imports, a massive share that underscored how deeply New Delhi had aligned with Moscow's energy markets despite years of Western sanctions. Only 3 weeks after that revelation, Donald Trump, seeking to reinforce American dominance in global trade, signed an order slapping an additional 25% tariff on Indian goods. Yet the Indian government, far from retreating, did not cut a single barrel of Russian oil from its purchases. The math was simply too powerful to ignore. Discounts of up to $12 per barrel made Russian crude irresistible for a fast-growing economy where every cent mattered. For Washington, India's defiance highlighted a hard truth. Tariffs and threats were not enough to bend large economies when strategic interests were on the line. European governments saw the same lesson. Punitive tariffs, no matter how heavy, could not guarantee behavioral change. And inside the European Union, divisions only widened as the United States pressed harder. Hungary and Slovakia, both deeply dependent on Chinese integrated supply chains, sounded alarms that blanket tariffs would paralyze their domestic industries, leaving factories idle and workers unemployed. Poland, more closely tied to U.S. security positions, signaled it might cooperate, but only if exceptions were carved out for key sectors like agricultural machinery. Italy hesitated, pointing to hard numbers. According to Eurostat, Chinese tourism had poured €6 billion into the Italian economy in 2024. Cutting those flows meant real pain for hotels, restaurants, and luxury retail. Meanwhile, Ursula von der Leyen, president of the European Commission, avoided committing the bloc to America's strategy. In a September policy paper reviewed by the Financial Times, she wrote that Europe must balance strategic autonomy with global cooperation. To diplomats, this read like a refusal to follow Washington into a trade war. It was deliberate ambiguity, language designed to preserve space for maneuver while dodging U.S. pressure. By August 2025, the cracks in the coalition were clear in the data. Eurostat reported EU imports from China still made up 21.3% of all external imports, up slightly from the previous year. Exports to China represented 8.3% of EU outbound trade, a critical slice of the bloc's economy. Cutting those ties overnight with a sudden 100% tariff would mean erasing nearly a tenth of export revenues in a single stroke. For Germany alone, that would translate into more than 400,000 jobs lost, according to the EPO Institute. The cost of compliance with Washington's demand was politically untenable. The United States, however, had tools of its own. On September 25th, Politico reported Trump had announced sweeping new duties: 100% on pharmaceuticals unless produced in U.S. plants, 25% on heavy trucks, 50% on kitchen cabinets and vanities, and 30% on upholstered furniture. These measures were sectoral, immediate, and unilateral. They demonstrated America's ability to inflict pain without waiting for allies. But they also exposed a contradiction. If Washington could act alone with a pen stroke, why was it demanding that 27 European governments take the lead abroad? That question eroded U.S. credibility. European officials, speaking anonymously to Reuters on September 29th, admitted they no longer believed their quest was genuine. One called it performative pressure, a political theater designed more to signal toughness than to form a real coalition. Another argued Washington's true aim was leverage over Beijing, using the threat of a united Western front as a bargaining chip in negotiations. In that light, the collapse of the European alignment was not a failure, but the function of the strategy itself. The threat had served its purpose. Still, threats carried consequences. Beijing accelerated its outreach beyond the Western sphere. In late September, China announced a $10 billion credit line for infrastructure projects in Brazil and Argentina, strengthening its foothold in Latin America. Simultaneously, it expanded a currency swap line with the Bank of Thailand, boosting yuan liquidity for regional trade. These moves made China less vulnerable to Western financial and tariff coordination. Adaptation became its form of resistance. By the final days of September, the debate had shifted. No longer was the question whether 27 EU states would line up behind 100% tariffs. They would not, but rather what the breakdown of coordination meant for the global order. Investors braced for a fractured system. The WTO warned in its September trade outlook that global merchandise trade volume would contract by 1.2% in 2025, the steepest decline since the pandemic. The OECD cut projected EU growth to just 0.8% for 2025, citing trade restrictions as a primary risk to stability. At the White House, officials maintained that the strategy was intact. Yet behind the scenes, legal challenges cast shadows. The Financial Times reported that lawsuits questioning Trump's use of emergency powers under the International Emergency Economic Powers Act were moving quickly toward the Supreme Court. Some advisors argued fallback statutes, Section 301 and Section 232, could still preserve tariffs. But the legal uncertainty revealed how contested the trade war apparatus had become inside America itself. The collapse of the Grand Tariff Plan was therefore multi-layered. Externally, allies balked. Internally, the legal framework shook under judicial scrutiny. And globally, markets responded with volatility. On September 30th, the Dow dropped 2.1%, its worst single-day fall since March, after reports of U.S. outreach to allies leaked. Commodity prices jolted. Copper climbed 3% on expectations of disrupted Chinese supply chains, while soybean futures plunged as traders anticipated Chinese retaliation. By October 1st, diplomats quietly admitted reality. The dream of a unified 27-nation tariff wall was gone. Europe would pursue narrow steel quotas. The U.S. would escalate selectively. China would retaliate with careful, calibrated countermeasures. What remained was not a coordinated strategy, but a fragmented landscape where each power acted alone. The global economy, caught between these oscillations, faced uncertainty not as a passing shock, but as the new normal. And so the final image was not of unity, no joint declaration, no signatures on a common document. Instead, it was one of absence, empty chairs at a Brussels summit table where collective resolve was supposed to be displayed. The collapse did not come with fireworks, but with silence. And it left behind an unresolved question. If America cannot bind its allies to a tariff war, and if China cannot be isolated through coercion, is the world now entering an era where economic warfare achieves nothing but erosion on all sides, slower growth, weaker alliances, and a global order defined not by dominance, but by fragmentation?